Hey everyone, welcome back. Today we're doing a deep dive into a fascinating topic, how our own psychology can impact our investment decisions.
Yeah, it's really interesting stuff.
We'll be pulling excerpts from Michael Bailey's book, Stop, Think, Invest. Have you had a chance to look at this one yet?
Oh, yeah, definitely. It's a really insightful read, you know. It kind of makes you realize how much our emotions and biases can influence, like, even big financial decisions.
Right. I mean, it's not just picking stocks, it's understanding ourselves too.
Absolutely.
So Bailey starts off with this story about General Electric. Remember, like back in 2015, 2018, their share price just tanked. It went like from about $1.20 down to 65 cents.
Yeah, it was a huge fall. And a lot of people, a lot of really smart people, missed the warning signs.
And it makes you think, if these experienced investors got it wrong,
hmm
what can we learn from that?
Well, that's exactly what behavioral economics tries to do. It helps us understand why we sometimes make irrational choices, even when we think we're being logical.
Okay, so how do we avoid those traps?
Mhm.
What I liked is that Bailey lays out like this 12-step investment process. But don't worry, we're not going to go through all 12 steps here.
Yeah, that'd be a bit much.
Right. We're going to hit the highlights, those aha moments that make you go, oh, I do that too.
Exactly. And I think, a good place to start is just understanding the investment cycle itself. It's kind of this continuous loop.
Okay, break that down for us.
So you start with generating ideas, then researching those ideas, setting your expectations, figuring out your timing and how much you want to buy.
Okay.
Then you've got analyzing your results, deciding when to sell, reassessing your strategy, and, the cycle just keeps going. And the key is that you're always learning and adapting along the way.
It sounds, straightforward enough when you put it like that. But where it gets tricky is sometimes we have too many options.
Oh, for sure.
Right. And that can actually be paralyzing. It's like staring at a restaurant menu with 100 dishes, and you spend more time agonizing over the choice than actually enjoying the meal.
Yeah, I know that feeling. That's the paradox of choice.
Right. And I'm guessing that can lead to, bad decisions in investing too.
Absolutely. You can get stuck in analysis paralysis or, even just make impulsive decisions based on like superficial factors.
Yeah. So how do we narrow down those options? Bailey talks about, he calls it like a libertarian and paternalistic approach.
Yes. That's a really interesting way to think about it.
It sounds very, very like political science-y.
It does. But in this context, the libertarian part means staying open to all possibilities at first. You don't let any preconceived notions limit your thinking.
Okay.
But then the paternalistic side comes in, where you use, knowledge and analysis to filter those possibilities down to a more manageable set of choices.
So it's like, I'm thinking about opening my refrigerator, seeing all those ingredients, and then like, okay, what am I actually going to cook here?
Exactly. That's a great analogy.
So Bailey, he uses this example of picking an investment sector back in 2016. He was looking at like cloud computing, cybersecurity, self-driving cars. I think he already had some investments in cloud computing.
Right.
And then self-driving cars felt, I think, too risky at that time.
Yeah. A bit too speculative, perhaps.
Right. So he landed on cybersecurity, it felt like, kind of that middle ground.
Makes sense, finding that sweet spot.
Right. Okay, so that brings us to another idea I think we need to unpack. System 1 and System 2 thinking. Daniel Kahneman, right.
Yeah, his work is fantastic.
Okay, so remind me. I think System 1 is like me right now, chatting, having fun. And System 2 is more that focused thinking, like when I'm actually researching a company.
Perfect example. System 1 is that automatic, effortless mode of thinking. Like, when you're scrolling through social media or even driving a familiar route.
Right, you don't even think about it.
Exactly. System 2 is more deliberate. It's that analytical mode we need for, complex tasks. Like actually analyzing those financial reports, making those big investment decisions.
But here's the thing. Even when we think we're being all rational, System 2, all that, those biases can creep in, right?
Oh, absolutely. They're sneaky like that.
And Bailey talks about this inside view. What's the inside view?
It's when we get so caught up in a company's story, the hype, that we kind of lose our objectivity.
So it's like falling in love with their marketing instead of like actually looking at the numbers.
Exactly.
Okay, so I'm guessing that's where we need to have those questions in our back pocket to kind of challenge our assumptions, right?
Absolutely. When you find yourself getting pulled in by that narrative, you got to ask yourself, okay, is this growth sustainable? Are they truly innovative? Or are they just repackaging old ideas? Are there any red flags in their financials that I'm overlooking? Things like that.
Excellent questions. So I'm starting to realize it's not just about the numbers, it's about understanding ourselves, right?
100%.
Mm.
Knowing those biases can be a real game changer. So we were talking about biases, right? Like how even when we think we're being all rational and objective, these mental shortcuts can really trip us up.
Yeah, it's like our brains are working against us when it comes to investing.
In a way, yeah.
Yeah.
And we talked about that inside view bias where we get, seduced by the company's story.
Right, the hype.
Exactly.
Hmm.
But there are other biases to watch out for, too.
Okay, like what? Give us some examples.
Well, one that's really common is the availability bias. Basically, it means we tend to overvalue information that's, readily available or easily comes to mind. Like
Yeah.
if we're constantly seeing news articles about a certain stock.
We just assume it's a good investment.
Right. Even if the fundamentals aren't that strong.
So it's like, just because we hear about it a lot doesn't mean it's actually a good idea.
Exactly. It's like thinking that, sharks are the biggest threat in the ocean
Yeah.
just because shark attacks get a lot of media coverage.
Oh, that's a good analogy.
Right. But in reality, things like rip currents are way more dangerous, but they don't make for such dramatic headlines.
Okay, I never thought about it like that.
So in investing, it's all about consciously seeking out diverse sources of information.
Not just like, what pops up on our Twitter feed.
Exactly. Don't rely solely on what's trending or what everyone's talking about. You got to dig deeper.
Yeah.
Read industry reports, check out company filings, look for analysis from reputable sources that offer different perspectives.
So it's about getting a more balanced view, expanding our information bubble.
Precisely. And another common bias is risk aversion.
Okay, explain that one.
It's our natural tendency to avoid losses, even if it means missing out on potential gains. Like, Bailey gives this example of choosing between, a guaranteed $5 refund or a $10 refund that requires some effort.
I think most people would go for the $5, right?
Exactly. We go for that sure thing, even though we're leaving money on the table.
I can see myself doing that.
We all do it. But in investing, this aversion to risk can make us too conservative. We end up sticking to those so-called safe options, even if they might not generate, significant returns.
So how do we overcome that fear? How do we make, smarter choices?
Well, one way is to broaden our investment framework. Instead of just focusing on minimizing risk, think about, a range of possibilities. What aligns with your overall financial goals, your risk tolerance? Remember Bailey's example with cloud computing, self-driving cars, and cybersecurity?
Right, finding that middle ground.
Exactly. Okay, so let's say we've done our research, we're aware of these biases, and we have a good understanding of our risk tolerance. What's next?
Time to pick some stocks, right?
Well, not so fast. It's time to craft your investment thesis.
Okay, I've heard that term before, but what does it actually mean?
It's more than just, picking a stock. It's about articulating your reasoning. Why you believe this company will outperform the market.
So I'm like making a case for it.
Exactly. It's like writing a persuasive essay, but instead of convincing your professor, you're convincing yourself.
I like that.
And Bailey really emphasizes having a clear, well-defined thesis. It helps you stay focused on your goals, make informed decisions, and not get swayed by, emotions or market noise.
So he has an example, right? The Amazon investment.
Yeah, back in 2018, he saw potential in their online ad sales, comparing it to Google and Facebook, which were already making huge revenue from ads.
Right, but he didn't stop there.
No, he also looked at Amazon's strengths in e-commerce and cloud computing. He calls this the three-legged stool approach.
So you have multiple reasons to believe in the company.
Exactly. If one area weakens, the others can still support the investment.
That makes sense. A more resilient approach.
Exactly. Okay, but what happens when, inevitably things get a little bumpy in the market?
Right, because we know they will.
Yeah.
What keeps us from, panic selling when a stock starts to drop?
This is where understanding loss aversion comes in again. Remember, that feeling that losing money is twice as painful as gaining the same amount.
Yeah, that hurts.
And that instinct can make us do some irrational things,
Like selling at the first sign of trouble, even though it might just be a temporary dip?
Exactly. Our system one thinking takes over, right? Urging us to get out, avoid further losses.
Get me out of here.
But that's when we need to engage system two, slow down, think it through, analyze why the stock is dropping. Is it just market noise, or is there, a fundamental problem with the company?
So deep breaths, Analyze the situation before making any rash decisions.
Precisely. And Bailey also warns against getting caught up in media hype or, anchoring to initial expectations.
Oh, right. Like, when health insurance stocks dipped before the 2016 election.
Exactly. Some people panicked, sold everything. Others saw it as a buying opportunity.
And it all depended on their perspective.
Exactly. Okay, and speaking of sticking to your thesis, Bailey shares his experience with this medical device company, Covidien.
This is the one he bought in 2007, right?
Yeah, right before the recession hit. Talk about bad timing.
Oh.
But his thesis was based on, Covidien's strong position for growth after spinning off from, I think it was Tyco.
Okay.
And even though the recession caused, some initial turbulence, the underlying fundamentals of his thesis remained intact. So he held on to the stock, and eventually it outperformed the market.
Wow. So he rode out the storm and came out ahead.
Exactly. A good reminder that a solid thesis can really be your anchor in those turbulent times. But what about when, even with all the research and planning, things just don't go as we hoped?
Right. We're human. We make mistakes. How do we deal with those investing flops?
That's where having a growth mindset is so important. It's about viewing mistakes as, opportunities for learning, not as failures.
So we learn from our losses, just like our wins.
Exactly. Analyze what went wrong. Was there a flaw in your thesis? Did you miss some key information? Did you let emotions cloud your judgment? Things like that.
So instead of beating ourselves up, we treat it as a learning experience.
Exactly. Each mistake is a chance to refine your strategies and make better decisions going forward.
It's like that saying, you win some, you learn some.
Exactly. And sometimes the most valuable lessons come from those investments that didn't work out.
That's a good perspective. And I think you mentioned something earlier called the break-even effect.
Oh, yes. That's another interesting concept. It's our tendency to, hold on to those losing investments even longer than we should.
Hoping they'll come back.
Right, hoping we can at least break even. And it often stems from that loss aversion we were talking about, that fear of losing money.
So instead of cutting our losses, we just keep hoping for the best.
Yeah, and sometimes we even throw good money after bad, try and make it all back.
It's like that gambler's mentality, right? Just one more hand and I'll win it all back.
Exactly. But the problem is, this kind of thinking can actually lead to even bigger losses. We become emotionally attached to the investment and lose sight of the bigger picture.
So how do we break free from that cycle? How do we know when it's time to cut our losses and move on?
Well, one important thing is to have a clear exit strategy in place, like before you even invest.
So you're not making decisions based on, panic.
Exactly. Decide in advance what conditions would trigger a sale.
Yeah.
Whether it's, a certain percentage drop, a change in the company's fundamentals, or even just a shift in your own financial goals.
Okay, so those guardrails are already there.
Right. And another technique that can be helpful is it's called mental accounting.
Mental accounting, what's that?
Instead of viewing each investment in isolation, you think about your portfolio as a whole. So even if one investment is down, if the overall portfolio is still performing well,
You don't freak out.
right, it helps you maintain a more balanced perspective and avoid overreacting to, those individual fluctuations.
Okay, I'm seeing how all these pieces fit together. We're using behavioral economics to basically build a more rational, disciplined approach to investing.
Exactly. It's about taking control of those emotional impulses.
Right. Any other practical tips or tools we can use?
Checklists.
Oh, I love a good checklist. What would that look like for investing?
Well, have I reviewed the company's financial statements? Have I researched the industry, the competitive landscape? Have I considered the management team, the company's valuation?
Okay, so those are all things we've talked about.
Right. Those are the essentials.
Yeah.
And, most importantly, does this investment align with my overall financial goals and risk tolerance?
Right. Coming back to that. So we've got our checklists, but we also can't just, set it and forget it, right? We need to actually keep tabs on our investments.
Absolutely.
Yeah.
Regular monitoring is key. It's so easy to get caught up in, the excitement of buying, but then we forget to actually check in and see how things are performing.
Right. How often are we talking about?
Well, it depends, on your individual approach, but many online platforms and brokerage accounts offer tools for tracking your portfolio's performance. You can also use, spreadsheets or personal finance apps, whatever works for you. The key is just to have a system and stick to it.
So regular checkups for our investments.
Exactly. And that way you can spot any potential problems early on, before they snowball into something bigger.
Okay. And that can help us avoid those, big emotional decisions.
Right, because then you're not reacting out of fear or panic. you're making those adjustments in a more calm, rational way.
Okay, so we're monitoring. Anything else?
Rebalancing.
Hmm.
So as your investments perform, some better, some worse, your asset allocation can drift from your original target. So rebalancing is about, selling some of those investments that have done really well and buying more of those that have maybe lagged behind.
So it's about maintaining that balance, that diversification that we talked about.
Exactly. It helps you stay aligned with your goals and avoid, taking on more risk than you're comfortable with.
It's interesting. At the beginning, I thought about investing as, kind of a gamble.
Right.
But it sounds like it's really a skill that you can hone, a process of learning and improvement, and not just, luck or chance.
That's a great way to put it. And remember, it's a marathon, not a sprint. You need that patience and discipline. Resist the urge to chase the latest hot stock or make those impulsive decisions.
It's about like tuning out the noise and focusing on that long-term strategy, right?
Exactly. And before we wrap up, let's go back to those 4 key questions from Richard Thaler, remember? Who uses? Who chooses? Who pays? Who profits?
I've got to write those down.
Keep those questions in mind when you're evaluating any potential investment. They'll help you, cut through all the hype and really understand the underlying dynamics of the business.
I feel like I've gained a whole new perspective on investing, and I'm definitely walking away with a lot to think about.
The key takeaway is this. Understanding behavioral economics can make a huge difference. By recognizing our own biases, putting systems in place, to mitigate their impact, we can make more rational, informed decisions.
And hopefully avoid some of those costly mistakes.
Exactly. And ultimately, achieve those financial goals that we're all working towards.
Well, I think that's a great place to leave it. Thanks for taking this deep dive with me, and to Michael Bailey for his incredible book, Stop, Think, Invest.
It's been a pleasure. And to all our listeners out there, happy investing.